Excess burden of a labor income tax computation with the Gauss Program, Chapter 5, Welfare Tau L.G. So welcome to the third video in a row on the sequence of computing the excess burden of a labor income tax. In the first two parts, we have looked at the partial equilibrium and the general equilibrium and computed the excess burden. So the partial equilibrium excess burden was equal to 4.7% of a 1% increase of the labor income tax rate from 23 to 24% in the US. And the general equilibrium effect was higher, so the excess burden was 6.8% of tax revenue. Now in this third episode here, we are going to compute the excess burden with the help of a Gauss Computer program. In order to benefit from this video, you should download the computer code Chapter 5 Tau L welfare.g from my homepage. You should also download the slides for Chapter 5, in particular Section 5.3 on labor income tax. And of course, you can also read it in my book on public economics. So what is the economic problem about? Let me briefly review what we learned so far in the first two scenes. So open the slides on Chapter 5, Income Taxation, for my book Public Economics, the Macroeconomic Perspective. Let's go into labor income taxation and skip through the material for partial equilibrium. Let's go right into general equilibrium, where we look at the Ramsey model. So here, a household maximizes intertemporal utility by discounting instantaneous utility in period t by the discount factor beta. Instantaneous utility U is a function of consumption C and labor L. Now we specify a Cobb-Douglas utility function with weights iota and 1 minus iota on consumption and leisure respectively, so that in the equilibrium the allocation of the total endowment with labor income and capital income is located on consumption and leisure in the proportion iota and 1 minus iota. 1 over sigma denotes the intertemporal elasticity of substitution, and household own the capital stock and accumulate the capital stock according to equation 6. So capital stock increases with investment IT, which is equal to savings, and is reduced by depreciation delta times KT. The household budget is given by equation 7. So on the left-hand side we have income, net labor income. WLT is our gross labor income, which is taxed at rate tau L, our income tax rate. And we will consider the effects of an increase of the labor income tax rate from 23% to 24%, with 23% being the average over the last 50 years in the United States. The household also receives interest income RTKT, and he is spending his income on consumption CT and savings, which increase the capital stock according to equation 6. From this optimization problem, we can derive the first order conditions 9a through 9c, which are the first order conditions with respect to consumption, labor, and capital stock next period. So 9c is the so-called Euler or Keynes-Ramsey rule. 9a and 9b imply the optimality condition on labor supply, which is presented by the last equation. Now, goods and factor markets are characterized by perfect competition, and we assume that production is characterized by a Cobb-Douglas technology with capital and labor, and the capital income share is denoted by alpha, and the labor income share is denoted by 1 minus alpha. We will set alpha to the US value of 36%, alpha equal to 0.36. Now, with perfect competition, factors are rewarded by their marginal product, so that the wages W and the interest rate R are simply equal to the marginal product of capital and labor, which are presented in equations 11. Government runs a balanced budget, so total taxes income are labor taxes. We just have one tax in our model, tau L times WL, and this is spent on government consumption, G, which is a pure waste, so it neither affects utility nor production in our economy. When we insert the budget constraint of the fiscal authority 12 and the factor prices W and RT in the individual budget, equation 7, we derive the resource constraint of the economy. So the total production Y is equal to total demand, and demand is consumption demand of the household C, public consumption G, and investment IT. Now in steady state, this model can be described by 6 equations in equation 14a through 14f. The first one is a steady state Euler condition. Second one's first order condition with respect to labor. Then we have the two marginal products are equal to the factor prices, the resource constraint, and the fiscal budget constraint. So these 6 equations determine our 6 endogenous variables R, W, C, L, K, and G. Now we first calibrate the model, and we can do this recursively. So for given beta and delta, we can compute R. From R, we can compute the capital labor ratio, K over L, by equation 14d. With the capital labor ratio, K over L, we can compute the wage. We choose the labor supply in steady state to be equal to 30%, 0.30. So with this value of L, we can also compute the capital stock K, and from the resource constraint 14e we can compute consumption. So we can compute all values here starting from a labor supply L equal to 0.3 and parameters beta, delta, alpha, and tau L. So then we have one free parameter, which is iota, and we use our endogenous values of C, L, and W to compute iota from equation 14b. So this constitutes our calibration, and let me give you the values that we have chosen. We took beta, value of beta equal to 0.96, so this implies a real interest rate after depreciation equal to 4%, so which is approximately the average value over the last 50 years. Depreciation rate delta is set equal to 10%. Labor supply is calibrated in the steady state equal to 30% in the initial steady state, with tau L, the labor income tax rate, equal to 23%. The capital income share is chosen to be 36%, or equally the labor income share is chosen to be 64%. This is a little bit high. So this means 64%. Well, in the United States, we have observed that the labor income share has declined from 62% to 57% over the last 40 years. And we choose this value in accordance with the literature, which has often applied the value of 0.36 for alpha. From this, we can compute the government share, which is 14.7% of GDP, and calibrate iota 0.3423 from the first order condition with respect to labor. And for the transition, we also need the value of the intertemporal elasticity of substitution, which we set to 1/2, or equally to sigma equal to 2. Notice that we do not need the value of the intertemporal elasticity of substitution for the computation of the steady state. Now everything is computed with the help of the Gauss Computer program chapter 5 welfare tau L dot G. We also want to compute the dynamics which are presented in this slide here. So we assume that in period up to period 0 we are in old steady state, and then comes an unexpected change in period 1 that tau L is set equal to 24%, so increased by 1%. As a consequence, labor supply declines drastically and undershoots its neuron equilibrium value, and the capital stock slowly adjusts to its new steady state value, as you can see from the upper row of this figure. So what we get from this, well, we start the transition for the old capital stock and gradually get to the new capital stock. And the question is, how do we solve this dynamic problem computationally? Now what we do is we apply the method of reverse shooting, which is explained in more detail in my chapter, in the appendix 4.1 in my book. So what we do is we start in period 41 and assume we are in the new steady state with variables k, l, and c. Now next we specify a value of k40, so the capital stock in the period 41 period prior to the new steady state. And we can compute labor and consumption in period 40 from this guess, with the help of this guess, from the first order conditions of the household and its budget constraint. Next we look at period 39. In period 39, we are wondering what are the values of the capital stock, labor, and consumption for given variables for given values of these variables in period 40, and then we go on to compute this problem by looking at the three dynamic equations 15a through 15c. So we are given kt plus 1, lt plus 1, and ct plus 1. And with the help of these three conditions, we can compute kt, lt, and ct. This amounts to the solution of a nonlinear equation system in three variables ct, lt, and kt. The first equation is the first order condition with respect to labor, which is a static condition. The second one is our budget constraint. And the third equation is our Euler equation, where we substituted the marginal utility of consumption for our Lagrange multipliers lambda t. Okay, and we compute kt, ct, lt for given kt plus 1, lt plus 1, ct plus 1, and then we iterate backwards in time until we hit period 0. And in period 0, we compare our implied capital stock K0 with the initial steady state, and if they are equal, we are done. Then we have found the solution to this two-point boundary value problem between the new and the old steady state capital stock. And if not, we have to re-specify our initial guess for K40. And this will be the task of our numerical program, chapter 5, welfare tau L dot G, to which we turn next. Okay, here you find, please load the program chapter 5 welfare tau L Gauss 19G into your editor. Open and then locate the file here, open it and load it into your editor of your Gauss program. There are two versions of this file, chapter 5 welfare tau L in in my download zip file. One is for old versions of Gauss, and here I use the one for Gauss 19. I have version Gauss 19.1. The reason is that Gauss has introduced new graphics commands in recent versions, so that's why I had to specify different programs here so that you can apply the appropriate version. Now check the header first, so you have the right program here, that you look at chapter 5 welfare tau L Gauss 19, and to find out if it works okay, so just run it by Control R and see if it runs through. You have to press a couple of wait statements, a couple of keys on your desk keys, so that the execution continues. And if it runs through fine, you should have something like this in front of you, the final graphics. Don't worry, we will get a much nicer view of these. And go back into the edit mode. What we will do next is we debug this program together. So for this reason, press the red button in the top menu bar, and we go through the code together, line by line. In the first step, we do some house cleaning. So we clear the memory and we clear the screen, stuff like this, and include the toolbox point src in our program execution. So now Gauss knows that some procedures that we will use, he looks up in toolbox src in this file. So for example, the nonlinear equation system solver is stored in this toolbox. So please make sure that the file toolbox.pointsrc is saved in the same directory as your program chapter 5 welfare tau L Gauss 19.gss. So in the second step, we calibrate the model. So we set the labor income as a capital income share equal to 36%, the discount factor beta equal to 0.96, the depreciation rate equal to 10%, the sigma equal to 2, implying an intertemporal elasticity of substitution of 1/2, the labor supply in the initial steady state equal to 0.3, and the labor income tax rate equal to 0.23. In later runs, you can also try the tax wedge for the US that has been estimated by Prescott, tau L star equal to 0.40, or the tax wedge for Germany, which is 59%. We specify the number of transition periods NT equal to 40. So if this is not enough, well, we will see in the result that it is. You have to increase NT. And now comes the calibration. For given values of beta and delta, we can compute the real interest rate R. From the real interest rate, we have that the marginal product is equal to R. We can solve for K over L, the capital intensity. So for example, the capital intensity is equal to 4.294, and real interest rate is equal to 14%. Remember that this we have to also deduct depreciation to get to the real interest rate after depreciation, so which is 4%. And K star, our value of the capital stock in the initial steady state is 1.288. With the help of these values, we can compute the wage W from the marginal product of labor, the production from the production function, and for given tau L, W, and L, we can compute tax revenue, which are equal to government spending. So the government share in our model here is 14.7% of GDP. And then from the resource constraint, we get consumption. And with the help of consumption, labor supply, the tax rate, and the wage rate, we can compute the value of, it's Yoder. Yoda, we have named it gamma in this program, so please apologize for this. We can compute the Cobb-Douglas weight of consumption and leisure in utility, which is called Yoda in the program. Sorry, Yoda in the model. And this amounts to 0.3423 in our case. And the new labor income tax rate is equal to 24%, and we now compute the partial equilibrium effects. So when tau L is set to 24%, and how do we compute the partial equilibrium effect? Let me get back to the slides for this reason. So the partial equilibrium effect is computed as follows. We assume that the wage rate remains fixed, W, so the gross wage rate. Also, the capital stock remains fixed, so that the income of the household is net labor income, 1 minus tau L times WL, plus interest income net of depreciation, R minus delta times K. So this is the second line here on the second equation on slide 38. And we compute the new optimal consumption C prime and the new optimal labor supply L prime from these two equations, which are the the budget constraint and the first order condition with respect to labor. And I call this partial equilibrium because the wage and the capital stock remain constant at their old steady state values. And for this case, we compute the new equilibrium values L prime and C prime equal to 0.2994 and 0.2998. With the help of these new values, we can compute the consumption equivalent change delta, which is minus 1.07%. So this means that when we move to a labor income tax rate of 24%, the utility loss is equivalent to a loss of consumption equal to 1.07%. And we can compute the deadweight loss, which is the difference between the consumption loss and the additional tax revenue, and related to the additional tax revenue, and we get that the deadweight loss is 4.7% of additional tax revenue. This will be computed in the next step of our Gauss program here. So therefore, we have to solve the equation system in the budget and the first order condition. And this is a nonlinear equations problem, so we have to solve a nonlinear equations problem in two variables. As initial variables, we use the old steady state labor supply and the old steady state consumption, which is stored in variable x0. And now we solve the non-linear equation system with the help of the procedure fix v mn1, which is a procedure that is stored in the toolbox. So this procedure finds the zero of the procedure FOC1 and returns the solution XF, and in crit we store if the convergence is nice. So let us look into the function, the procedure FOC1, which is in line 431. Which is given in line 431. So we have the endogenous variable labor and consumption. In the first equation, we have specified the first order condition of consumption. In the second equation, we have stored the budget constraint if capital stock and the wage rate are constant. And we find the solution for this equation system FOC1, which is given by the variable xf, so 0.2994 and 0.2297 for labor and consumption respectively. So the percentage changes for these two variables are the consumption declines by 1.2% and labor declines by 0.1%. 9% if the tax rate is increased by 1 percentage point. And we can compute the consumption equivalent change equal to 1.0688% in line 79. So I introduced the weight statement after this first part here. And now we compute the extra government revenues, which we store in variable D tax. The deadweight loss, which is the difference between the consumption loss and the additional tax revenue. And the deadweight loss relative to the new tax revenues, which is given in percentage points here as 4.65% of tax revenue. This terminates step 3. Now we compute the whole stuff for the general equilibrium. So what do we do in this case? Let's go back to our slides and let's compute the general equilibrium effect here. The general equilibrium effect, to compute the general equilibrium effect, we look at the steady state, equations 14, and compute the solutions for tau L equal to 24%. So we compute R, W, K, L, C, and G for this case. So in our Gauss Computer program, well, we have to provide a guess of the endogenous variable L, C, K, W, and R, which are our initial steady state variables. Let's get into the steady state. And in the procedure steady state, and you find the steady state conditions in the 5 equations Y1, Y2, Y3, Y4, and Y5. The fiscal budget is already included in the resource constraint here, so tau L times labor times wages is equal to government expenditures. So we have dispensed of one endogenous variable G and just expressed the steady state here in terms of the 5 endogenous variables: labor, consumption, capital, wages, interest rate, and the first order condition was the 5 equations are the first order conditions with respect to labor, the resource constraint, the marginal product of capital is equal to the interest rate, the one of labor is equal to wages, and the Euler equation. So let's get out of this procedure. And of course, we just have made sure that we have specified the procedure steady state correctly so that all equations are equal to 0. So you should check this if you write a new procedure, if it holds for example, an initial equilibrium. And now we have introduced another weight statement, and let's compute the solution to this nonlinear equations problems in 5 variables for the new tax rate tau L new 24%. And we do this again with the procedure fix with the procedure for our nonlinear equations solver, fix V, M, N, M1. And we have the new allocation stored in the variables L new 1, C new 1, K new 1, W N1, R new 1. And government expenditures equal to tax revenues G new 1. And the percentage changes are now minus 1.2% and 0.162% for consumption and labor. And our consumption equivalent change amounts to 1.097% now in general equilibrium. So it's higher. We compute the deadweight loss in the same way as before and get a deadweight loss relative to tax revenue of 6.85%. So this we have finished our excess burden computation in general equilibrium for the steady states. But of course, during the transition, the welfare losses are different than a new steady state. So as we have observed in our result here, let me already present what we will compute in a second. Here our transition. Labor undershoots its long-run value, and consumption is higher than in the long-run value, so gradually decreases to its long-run value. This means that utility along the transition is higher than in the new steady state. Both variables, leisure and consumption, are higher during the transition. Therefore, utility is higher, and therefore the utility loss during transition is smaller. And we want to compute the average value loss for the remaining time of his life, so from period 1 onto 0 up onto period infinity. Now for this we have to compute the transition dynamics, and let's go back into our Gauss Computer program. How do we solve this? Now this is described here in a little bit in this header on step 5. We compute the transition variables in the variables kt, lt, ct. We specify in period 41 the variable values must be equal to the new steady state variables. In the period 40, we choose a value of the capital stock, K40. And this will be an input into the procedure find K initial, the outer procedure. This procedure returns K0, the value in the period 0 that we get from working backwards in time, doing a reverse shooting, so working from period 41 to 40, from 40 to 39, and so on until we are in period 0, and compare the period 0 value of the capital stock to the old steady state. If they're equal, we are done. Otherwise, we have to respecify a new guess for K40. Now, in the inner loop of find K initial, within this procedure, we compute the dynamics. So first for K40, we compute the labor supply in period 40 and consumption in period 40. And we do this, let's go back to our slides. We do this by solving the first two equations, 15a and 15b, for CT and LT. In the next period, in the next step, we compute K39, C39, and L39 for given values of K40, C40, and L40. So we compute KT, CT, LT for given CT plus 1, LT plus 1, and KT plus 1. Therefore, we use all three equations here. The first order condition with respect to labor, the budget constraint, and the Euler equation. And we find the capital stock, consumption, and labor in period 39. For given values of these variables in period 39, we can compute the value of the variables in period 38, and so on and so on. We're working backwards in time recursively until we are back in period K0, and then we compare this variable in K0 for our initial steady state to our initial steady state variable. And if this is identical, we are done. So going back to our computer program, let's go through it. In the next 10 line, we look for a good initial value of this K initial. So we know it must lie somewhere between K star, the old steady state value, and K new 1, and should probably be very close to K new 1. So we search over a grid, K grid, if our procedure K initial, find K initial, provides a value close to 0, and then we choose the value of this grid, K grid, which provides a value that's closest to 0. And this will be our starting initial value for the nonlinear equations problems to find the zero of find k initial nonlinear equation system. So let's step inside this procedure and go through the lines. So here we have the k young, which is our initial value k40 for our backwards iteration. We store the solution to the global variable x time path so that we can graph it later. So we have the final value, we have the initial value of this dynamics, we store k old to k0, which helps us to compute L and C in the procedure find LCP. So for given capital stock in period 40 and 41, for given labor and consumption in period 41, we can compute labor and consumption in period 40 in the procedure find LCP. Just like I discussed above, this is step 5.1. So labor in period 40 is equal to 0.2995 and consumption in period 40 is equal to 0.2997. We store the values of period 40 in the matrix x time path in the row 40, 41 and in the columns 1 through 6 for capital stock, labor, production, consumption, tax revenues and the period. And now we get to step 5.2 where we compute the value of the variables k, l and c in period t for given values of these variables in period t plus 1. So this is done in the procedure find LCPK. So let's go down to this procedure that you get an idea how it looks like. Where do we have find LCPK? Actually, we have to go up. Find LCP key here in line 301. In the three equations, y1, y2, and y3, we have the first order condition with respect to labor, the resource constraint, and the Euler equation. The given variables are the old consumption C1, old capital stock Q1 in period T plus 1, and the labor in period T plus 1, labor 1. And the endogenous variables are consumption in period T, C, labor in period T denoted by labor, and capital D in period T denoted by K. So we solved this problem for period 40, so that we now have computed the capital stock in period 39, which is given by 1.287, labor supply in period 39, 0.299595, and consumption in period 39, 0.2997. Store these variables again in the matrix x time path and continue to do so over the whole time horizon. So let's run through to the cursor. And we return our initial value of the capital stock from this backward iteration, which is stored in the variable x1, and compare it to the old steady state. And this provides us with a difference of 0.07776. So we are close to the initial value, but not exactly close. So we just have 0.077 is the difference between our backwards iteration and K star in the initial equilibrium. So now we go through a loop over K grid to find the best starting value. So our K grid is a grid of 100 equispaced points between the old and the new steady state. And when we go over this loop here, let's go to the end of the loop, we store the solution in the variable solution. And as you can see, somewhere between the second and the third grid point value, there's a change in the sign. So between these two grid points, our solution must lie. And we start with an initial guess, well, that's closest to 0, which is determined in the next couple of lines, where we have this initial value, which is the minimum of the absolute here of the solution, vector solution. And our initial value with which we start is 1.2861613 to find the solution here. And for this case, our procedure find k initial returns a value of 0.00049, so we're already very close to the true solution, which will be determined by the solution of the nonlinear equation problem in line 185. And the capital stock in period 40 the solution is 1.286153. So we are done with the computation of the transition dynamics here. And we can, in the next 10 lines, we compute the consumption equivalent change that results from this. So we have to compute lifetime utility for the old steady state, lifetime utility for the new steady state, and then we compute the consumption equivalent change delta by the percentage amount that we have to increase or decrease the old consumption profile, so the whole time pass in the old steady state value to get the same utility. And this variable is computed here in line 209, and we get that our consumption equivalent change is equal to minus 1.07% if we also include the transition dynamics, so it's lower than the value that we find by just comparing steady states. We graph the solution, and this is a little cumbersome lines of commands, so let's just get to the point where this solution is graphed. These are just graphics command, and this is the solution. Well, it doesn't look nice. This is a consequence of the setup in Windows. So let's change the display style in Windows. Go to 100%. And now we should be able to see the solution clearly. Okay, so let's summarize. We have just computed the transition dynamics. We have computed the partial equilibrium effect and computed an excess burn of 4.8%. We have computed the 4.7%, sorry. We have computed the excess burden for the general equilibrium, which amounted to 6.8%. We have computed the transition dynamics and the welfare loss to the household, even accounting for the transition dynamics, and this gives us a figure of 1.07%, so it's lower because utility is higher during the transition. We have applied two numerical procedures to solve this problem. One is the solution of a nonlinear equation system, which you can find an explanation in chapter appendix 2.1 in my book, which is an appendix on the Newton-Raphson method. And the second numerical method that we applied was the one of reverse shooting. So when we have a two-point boundary value problem, a difference equation system, and we have an initial value and a final value, and we worked back in time to compute the problem, you can, if you want to, you can think why we use it backwardly and why we cannot work forwardly. So we cannot start with the capital stock initial period 0, specify K1, and from this we can compute K2 and go on and see if it converges to K40. This is not possible, and you may try to figure out why this is the case. And I hope you enjoyed this little tutorial, and encourage you to work a little bit with the computer program. So why not try to compute the excess burden and the transition for the case of Germany, where tax rates are much higher, and find out why you should pity Germans who pay, where excess burden relative to tax revenue we will find is about 4 to 5 times higher than in, or even the marginal effect is even 10 times higher than in the United States. So thank you for your attention. And I and